Index investing or passive investing has grown more popular with investors. Even Warren Buffett touts the benefits of owning an entire index like the S&P 500 over the long term. An example of an index tracking ETF is BMO's S&P 500 Index ETF. It's the largest ETF in Canada that tracks this well-recognized and popular index. It provides exposure to the returns of the market cap weighted S&P 500 index at a low cost with a management fee of just 0.08%. This broad market ETF makes for an efficient building block in a portfolio, saving you time and effort while mitigating single stock risk. If you're looking for exposure to the largest and most liquid public companies in the United States, this ETF delivers an easy-to-use solution and instant diversification. Commissions and management fees and expenses all may be associated with investments in exchange-traded funds. Please read the ETF facts or prospectus of the BMO ETFs before investing. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 114. As always, joined by the three amigos. We've got Boomer, Keith Dicker here with his Patagucci jacket, IceCap Asset Management, Rich Diaz, PMG. What's going on?
PGM, get it straight.
PGM, Jesus, man. You guys keep changing the name every week.
No.
Well, it's another red flag, for the Loonie Hour. Frank's going to be all over that one.
Yeah, definitely.
I'm back from London. Oh, sorry. Go ahead, Keith. Yeah, let's hear your British accent that you had a few days.
No, I got no British accent. I did have a amazing pint of Guinness in a dark and dingy pub, so I was very happy. That was like the most important thing for me.
I had a Guinness guy.
Keith,
I didn't hear. You guys are talking over each other. I'll just let you figure it out.
Are you a Guinness guy? I don't like Guinness. That's my confession.
So on a scale of 1 to 10, if your Budweiser is a 1 in my mind, Guinness is a solid 10. That's the beer.
Like the other side of that trade. Team Bud.
Yeah. Guinness is a it's a proper pint. Is that good, Rich?
It's great. It's great.
Something like that.
You guys are too fancy for me. I have to stop hanging out with you.
Hey guys, I just discovered a new podcast that's not the Loonie Hour. You know, I branch out every now and then.
Okay.
And I bet you there's a lot of people, they're listening to our show. They're going to say, "Oh yeah, they watch this guy all the time." It's called Outdoor Boys. Have you guys heard of it?
No, what's that?
It's this American family. They, I think they're originally from the Virginia area, but they're up in Alaska now. And every week, this guy goes out in the bush by himself, just living like by himself, like building.
I thought that was like a Brokeback Mountain
snow
sequel.
cape. No, this stuff is fun. But the cool thing is, if you watch it, just realize the video production is one guy by himself. So it's one thing to have the what do you call the stick with your camera you put on it? A selfie
stick.
Okay, so he's walking around with that, of course, and he's pulling a 60-pound sled, backpack, snowshoes, and one trekking pole. But then you'll see these scenes where it's just him like walking over, a hill, which means he stuck the selfie stick in the snow to set up the scene to film it. He'll do it, then he'll go back and get it again. It's just amazing stuff that he has. But it's a lot of fun. I think a lot of people are they would be aware of it. So, Rich, if you want to broaden your view and give you something else to talk about besides the diffusion index, check out the Outdoor
Does this guy
Boys.
get chased by like bears and stuff or what?
No, he's pretty good with that stuff. You'll just watch it, you'll see.
Housing bears are after him out there in the woods.
They could be.
Well,
let's get on with it, guys. Getting towards the end of the year, 2023, a couple of weeks left, 114 episodes. And after last week's, it wasn't a debacle. I thought it was snowballing into a debacle at one point where, we had the feelings conversation about COP28, I think, and things. I remember when we finished, I was thinking, oh man, where do we go? But a lot of the feedback that I've seen and had with other people, it was a great conversation again. So once again, Steve, Loonie Hour, ahead of the time.
We'll save the cow farts conversation for later. Yeah, we'll tee it up as usually we do. Just to kind of preface things here, guys, the Loonie Hour has dedicated their holiday hour schedule over the next couple weeks. That we will continue to do episodes every single week, so we're not going to miss anything during the Christmas and holiday break. So we'll just kind of continue to plug along. Anyways, it's year end for the housing market here, so everyone's trying to tee things up for what the spring market's going to look like. That's like the next sort of telltale for housing. But we did get some national housing statistics that came out today as of this recording. Keep in mind that I find like a lot of this data is kind of backwards looking. Like if you think about the home price index, it's kind of this, Rich, you'll like this. It's this hedonically adjusted index that basically takes, recorded sales, which lag by nature. And so we can see the home price index declined by 1.1% month over month, which, hey, you start annualizing, that's a pretty big decline. Of course, most of that coming from the GTA. The GTA and Vancouver make up like close to 70% of the home price index. So when that index moves, I mean, to be honest, it's mostly reflecting of Vancouver and Toronto. But yeah, home sales continue to remain weak, well below long-term averages. Listings are starting to pull back. What we're seeing is sellers basically pulling inventory off the market. So we kind of had like a little mini surge of like listings where they were kind of running above normal, and now they're kind of back, falling off again. So long story short, that sort of national housing summary here is there's 4.2 months of inventory on a national basis. That's still below like the long-term average of about 5 months. So like all in all, it's still a housing market that is holding up fairly well. And when you consider the fact that rates went from literally like 1% to 6%. But we'll see how things shape up. I think the big question now is what's going to happen with interest rates. Of course, this has been the discussion on the show for the last number of weeks. The reality is most Canadians, once they see rates start getting cut, their mortgage payment starts going down. People buy payments. So I do think it's going to free it up. I'm not saying that there's a bull market on the horizon by any stretch of the nature, but that kind of leads us into the data points coming out of the US, because ultimately the US drives monetary policy here in Canada. And so, Rich, you had US CPI come out this week. What was kind of the takeaway there?
I think it came in right as expected, if I'm not mistaken. Yeah, so the prior number, so it came out on the 12th. We record this on a Thursday. It came out a couple days ago. And
you just stole Keith's line.
I did steal Keith's line. I did steal Keith's line. Yeah, I'm just looking at it here. So there's headline and core, which we always talk about. There's month on month and year on year. So the month on month actually rose. So the core month on month rose from 0.2 to 0.3, but that was as expected. And the year on year, despite what Joe Biden says, is actually still rising. It's just rising at a slower rate. You got to love community notes, man. That stuff just cracks me up. And so that's sort of fell to 3.1. And then core, which is obviously the thing that we look at, I think is the most important one because it excludes food and energy, which can be quite volatile. Basically was 4.0 sort of again. It's still well above target, as you can see. You can see, and then the other thing, one more thing is that core services was basically 4%. And I think that's really important. So a lot of that decline basically we've seen is the core goods. So it's really the goods that have really come down, and it's been washed out completely since 2020.
To chime in there on my usual rant on the rents. Is shelters driving still what? Is it like 2/3 of CPI like growth?
Yeah, it's a lot. I can't remember exactly the number. I'll have to dig it up. Give me a second.
Yeah, there was an interesting article in Bloomberg today actually showing that in Manhattan, for example, I mean pretty large, significant city, they're seeing declining rents for the first time in many, many years again. So declining rents in the residential market, and I think that's happening in a lot of fairly large US cities now. So it'll be interesting to sort of see how that's not going to filter through for like quite a while.
That's true. But funnily, it's just to complicate things even further. The rents are rising in the secondary cities. So I subscribe to the Daily Shot. It's really good sort of daily
I think I saw
email.
that piece.
and they actually had a chart. I don't know where they got that data from. But anyway, maybe I'll try to dig it up and we can share it on the podcast. But it was showed that rents outside of those major cities are starting to rise. So it's listen. Here are the takeaways. The takeaways are that inflation's still well above target. The drags from goods and a lot of the sort of pandemic stuff that we had to deal with have dissipated. There's still thrust. So like we know, there's still an impulse for higher inflation from things like services and shelter, despite the fact that we don't like the way it's calculated. And I think it's really interesting that core is still 4%, which is well above target. And you're getting some of the annualized numbers are starting to rise. So, you can do 3 month annualized rates. But in general, I think it's just more sort of benign data. And it will lead to Keith telling us what's going on in the Fed. And I don't know, Keith, if you have anything to add on that data specifically.
Yeah, one thing with the inflation number, I love how a lot of people say, yeah, inflation's coming back down. It's gone from 7, 8, 9% now down to 4%. And it's not coming down, I guess, as you guys pointed out. It's just growing at a slower pace. But a lot of people who have an incentive to say it is coming down, will certainly tell you that story. But just to be clear, everyone,
all those real estate guys.
Yeah, the price of stuff is not coming down. It's stabilizing. But like one of the but one of the data points I'm seeing now that comes out, it's the actual index for CPI, and it's the core one. So instead of having just the percentage change, they've created the index number. So the way you'll see that on your screen there, Rich, when you pull it up for that day. But the latest point, Rich, for your reference is 312, spot 251. You see that there? Mm-hmm. So the way to read this, back before COVID hit, you can interpret this as a basket of goods, right? Which could be a lot of different things, but that's about $265 for a basket of goods. Now that same basket of goods now is about $312, and it's still increasing.
What's 312 divided by 260? Uh-oh.
There he goes.
It's about 20%.
Yeah. So there you go.
That sounds about right.
And well, no, I don't think it's right at all. I mean,
I don't think it's right at all either. Yeah, I think it's way more.
Yeah, absolutely. Yeah. Think about, whatever you buy at the grocery store all the time. So
wait, 20% over what was the duration of time?
Like 3 years roughly.
Yeah, like almost 4 years now. So before COVID, so 2019.
Oh, 4 years. Yeah, that's
but that's the challenge though with trying to calculate an inflation data point. That's why like the absolute number doesn't really matter. It's the direction that it's moving. So it is great that it is no longer increasing as fast as it was before. So that has changed, but there's no way they're going to be able to resolve to get prices back to where they were 4 years ago. Again, a lot of the decisions made back during COVID, it's just completely tilted the world off its axis, and it's still going this way. Another interesting thing, people talk about, hey, like the central banks have, they fixed inflation, they did it, they're really good and everything. Remember, they had rates at 0, near 0, and negative, and they did QE for over a decade. And Rich, how much inflation do they produce?
I mean, 0. There was lots of asset inflation, which is why I'm really not a big fan of central banks. Sorry, Steve, go ahead.
Well, no, that was like the point I was just about to bring up, is like we had inflation was like, what was it? Was it Krugman that said it? He was like, what did he call it? He called it something that like inflation sub 2% is like the issue of our decade or something.
Oh yeah.
And it's a good point.
I don't remember the exact terminology he said, but it was like, this is a crisis that we're having inflation at like 1.8% and not 2.0.
Yeah. But think about this, because most people, we talk about inflation, is the price of stuff. How much does it cost now to buy, your Big Mac or your, not Budweiser. No one buys Budweiser, but Guinness and stuff, or chicken fingers, at Loblaws, whatever you're doing. That's how most people think about inflation. But the point is that when they kept rates at 0, near 0, and they did QE, or some people call it money printing and everything, it didn't create the inflation that they were trying to create. Instead, what it did, it created what I think Steve or Rich, when you guys said asset inflation, which is really the price of houses going higher, stock market going higher, antique goods going, like you name it, right? Everything went higher. And that's where you get the wealth gap, taking place. So a lot of people say, central banks, they're in the business of making, the wealthy wealthier. That's a perfect example of it. Absolutely. And I don't know what they've resolved now at this point, but it's a bit awkward, isn't it?
Hey there. Have you been keeping up with Addy? It's not just your average platform. It's now Canada's largest real estate crowdfunding sensation. I'm a proud member, and let me tell you, it's a game changer. I use Addy to invest in top-notch institutional commercial-grade real estate, not just in Canada, but in the good old US of A. Get this, Addy has enabled a whopping 38 properties onto the platform. The best part, everyone, yes, everyone from all corners of Canada can now jump in on the action. But that's not all. Real estate investing with Addy opens the door to a world of benefits: passive income, capital appreciation, mortgage paydown. So what are you waiting for? Join the Addy community and unlock potential real estate investing. Head over to addyinvest.ca and use promo code Loonie Hour. That's addyinvest.ca, promo code Loonie Hour. That takes us to our next topic of conversation, which is, did we just get a Fed pivot? You had Jay Powell out yesterday, the much anticipated speech from him. And so basically what they did is they updated, for those that aren't maybe aware, is they put out these dot plots. Okay. So basically it's like, where does the Fed forecast where interest rates will be, 12 months, 18 months from now. And based on the dot plots, they're expecting 3 rate cuts next year. So that's what the own Fed officials, I don't know how many PhDs they have there, but they got a lot of them. And so they're projecting 3. Now the markets are projecting, or betting on basically 6 rate cuts next year from the Fed. So, but Keith, I think the main takeaway from Fed's Powell's speech there was that I think it was a dovish speech, and they updated their dot plots to say, hey, we actually are now starting to talk, and the dialogue is now about, okay, when do we cut? And again, of course, they're sort of projecting 3 cuts next year, which kind of took markets for a bit of a turn.
Yeah, I mean, absolutely. So with these things, you have to take it like on the face of it. Like, what did they say, and what are they telling you? And they clearly, they're calling it a dovish pivot, I think, or the Fed pivot. I think
is that a panic pause?
I don't think it's a panic pause anymore.
It wasn't a panic pause. No.
Yeah, the panic pause was everyone, 3 or 4 months ago,
because he knows he's screwed.
But yesterday though, it was very clear. So on the face of it, the Fed is saying, yeah, we're no longer really talking about raising rates. The next discussion is, when do we cut? And we're telling you, hey, maybe we won't cut, but most likely cuts will happen next year. When or how much, but we'll assess it when we get there. But they clearly, went from leaning into the wind to now they're going to have the wind, go with them. So there's a couple things with it though. And because you have to, put this whole puzzle together. We won't jump over the other ones yet, but it's always important to consider or know that, the Fed is the center of the monetary universe. And what they do, it affects everyone else as well. So, this morning you had the Europeans and also the Brits were out. And I suspect when Canada comes out next as well, and same with the Aussies. With the Fed saying, yeah, they're now thinking about cutting. And then with the Europeans and the Brits and everyone else saying, yeah, we're still worried. We're not even thinking about cutting yet. That's what the Europeans said this morning. It's effectively, it's very dollar bearish. So the US dollar comes down really hard. And that's what's been happening over the last 48 hours. But it's a great way for the global economy to reduce stress in the world. So back in 2018, remember that period when the Americans were raising rates, 25 basis points every second meeting, and no one else was raising rates. So it's one thing if they're doing and everyone else is. It was just the Fed doing it. Funny, it just choked the life out of the world. I suspect what's been happening over the last couple of weeks, the Fed, they're getting the calls from the Chinese, from the Japanese, the Europeans, and the Brits, and everyone else saying, hey man, we need to fix this right now because we're really starting to experience the stress economically and financially. And meanwhile, the Americans are saying, hey, we're not, we're actually this is ideal for us. But whereas every other central bank will make a policy decision for the benefit of our own domestic economy, that the Fed also has to do it for the world at the same time. So again, with the Fed sounding, pretty dovish there yesterday, and then everyone this morning saying, "Hey, yeah, we're not going to cut at all." Again, that's a pretty big difference in a rate differential, which will bring, the U.S. dollar then becomes less attractive from a yield perspective relative to everyone. So it was a really big policy meeting yesterday combined with what was coming out today. Did you hear that as well, you guys?
Well, Rich, yeah, I let you chime in, but I mean, I would imagine it seemed like everybody was pretty shocked. I mean, obviously the bond market rallied pretty hard there, yields collapsing. So
Yeah, I mean, shocked is fair, I would say, but also, I mean, a lot of those, you said there's 6 cuts priced in. What that means is sort of that's based on sort of a futures product, or either an option adjusted spread or some other kind of Fed fund futures product, or so not option adjusted, overnight index swap. Sorry. Anyways, my point is there's a product and people use that product to bet on what they think is going to happen. And what you mean to say is there's 150 basis points priced in, and you divide 150 by 25, and that's how you get 6. And so 6 cuts basically that are priced in. I think a lot of, up until a couple of days ago, before I left, there was already sort of 5 cuts priced in. And so really what I think although in some ways you could say, yes, the market was sort of caught by surprise, because yes, there was obviously a market reaction in risk assets. So financial conditions got easier. And so a lot of long duration assets went up. So tech, I think we're an all-time high, and I think the Dow Jones, tech's gone up. A lot of the European markets have really gone up when you have like those easier financial conditions. But I think that, I think you could make the case that a lot of this has already been priced in. Just using that sort of those 5 cuts versus 6 cuts. I think it also tells you, I think just stepping back, I think for me, the real takeaway from Powell's comments is they're just willing to accept much higher inflation, I think, full stop. I think that's, and whether it's because they need that, higher nominal GDP growth number to deal with, those record deficits, or they're using that higher inflation, above target inflation, to help alleviate the pressure offshore, as Keith alluded to, which is in either Japan or in Europe or whatever. I think, or they're just doing that because there's still a lot of debt in the system. And one way to deal with debt is to inflate it away, which is, again, why I just so against quantitative easing in the first place. Thank you, Ben Bernanke. But I think that that's ultimately what, he's saying. And then I think that's sort of my interpretation. I'm still sort of figuring it out, to be honest. I'm not really exactly sure how I feel about it. But I think in general, when you have core PCE at 3.5, yes, it's falling, but still 3.5, and their target is 2. And you have the Taylor rule estimates suggesting that your sort of neutral, monetary policy rate should be in the 7s or 6s. It tells you that it's actually markets are still relatively easy. And then that's why equity markets are sort of reacting the way they are.
Well, I think this kind of brings up the debate, right? So, like, I mean, the overwhelming consensus is this is a soft landing. Powell has seemingly pulled off the miraculous soft landing that, he raised rates, he got inflation down, it's going to keep coming down. He's going to land inflation, in the mid 2s, whatever. And we're going to have basically no recession, and we're just gonna, like, it's like the perfect soft landing. And so, the thing that's been surprising is that despite all of this, whether that happens or not, as it remains to be seen, but it's seemingly getting likelier and likelier that, like, that seems like a more probable outcome. However, every rate hike is almost typically followed by some sort of financial event, right, Keith? I mean, we really haven't. It's been surprising that to date we haven't had one. You're still kind of wondering, like, where is it? Is it just around the corner, and that's going to derail all these soft landing narratives? Because we had Silicon Valley Bank in last spring or this spring, and kind of didn't really create a whole lot of contagion, surprisingly. And again, I think everyone's just been waiting for this event to happen, and it hasn't happened.
Yeah, we also had the UK
Gilt market.
Yeah, Yeah, they felt really bad about that, Rich.
I wouldn't necessarily disagree.
Like, Keith, are you still
Steve
like,
didn't laugh. Steve didn't laugh at that joke.
That's
this is
okay.
serious matters right now.
Very serious.
I know.
When is
but
this financial event coming? What's going on? This is like, how can this guy raise rates, basically 500 basis points and nothing is seemingly broken?
Yeah, so I think the way it plays out is that it isn't a soft landing. Because let's just go through this scenario. Let's say it is a soft landing. Well, what happens with inflation again?
He's going to
It's
reaccelerate.
probably going to reaccelerate.
It's going to go to the moon, like blast off. There it goes, Alice. You're going straight to the moon. And hey, Steve's back into the game.
There you go. I like that one, buddy.
You didn't feel guilty about that joke, but that's okay.
Who the hell is Alice? Anyways, carry on.
You're into it now too. That's good. So, but if we get a soft landing, which means there's no recession, growth is a bit sluggish, is inflation going to get down from 4 to 3 to 2? Maybe, but likely not, because
Well, maybe,
hey,
but maybe temporarily.
maybe, yeah, like it's going to be difficult. But then the central bank is no longer cutting rates by, I think, 125 basis points for the end of 24. I think that's what's marked in there right now.
Yeah.
So instead, by June, they're now all of a sudden they're saying, hey, we're not cutting rates. We might actually, raise rates again. Like it turns into a bit of an awkward moment. But if we get a recession here, Steve, that's really the answer to your question, and that something comes flying off this tilter world. Does that make sense? The saucer, it's flying around pretty fast. And this has never been achieved before. So remember, we're in this monetary experiment now, almost 15 years into it, and people have been lulled asleep, and they think, hey, if it's not bad, right? You go to 0 and negative in QE, go from 0 to 5, and then maybe we'll bring it back down to 3.5. And we had all this debt piled on top of it. A lot of people are feeling good right now because we had 48 hours of bliss. It's been pretty good, and people buying the market this afternoon. Yeah, maybe you're getting a great buy, or maybe you're the guy buying at the high. It's always better to buy low and sell high, by the way. But you would have to expect that, again, the probability of something going a bit funny out there, it continues to creep higher. Nothing has been resolved at this point. Or has there been? What's been resolved? Why don't we talk about that next?
Well, I mean, I think Larry McDonald put out a good tweet here, which, the only one that had a worse interest rate forecast a couple of years ago than me was the Fed. So the Fed dot plots in June of 2021, the Fed is back in June of 2021, before they started hiking. All the PhDs at the Fed said that Fed funds in 2022 would be 0.25%, so no hikes. In 2023, they had it at 0.75. So they figured that rates would be at 0.75% in 2023, and of course today the Fed's at 5.5. So they missed by, what is that, 425 basis points, 450 basis points.
Just to jump in there, so just so people know, the dots are FOMC members. So when you can look this up online, if you just literally Google dot plots or Fed dot plots, and what they do is they every quarter they have sort of their monetary policy report in the same way that Canada does, and they present their view on the economy, but they also present different views on measures of central tendency with respect to GDP growth, wages, inflation, etc. And they asked these 17 members of the FOMC, which is the Federal Open Market Committee. Anyway, whatever. So I think I got that acronym right. Anyways, and so not all of them are voting members. So I think that they go in a rotation. I think either every year or every other year or whatever it is, there's a rotation of voting members. So 9 members vote. Obviously, the voting is strong-armed by the chairman. That's his sort of privilege. And of course, they would never admit to that, but that's basically what happens. And so those dot plots are effectively forecasts for, let's say, what they think the terminal rate of the Federal Reserve Fed funds rate, or the upper bound, will be for 2023, 2024, 2025. Sometimes they do a fourth year, that's new, and then sort of the long-term projections of what those numbers will be. And as you go further and further out, the dispersion of what they think that interest rate, that terminal Fed funds rate will be, widens. So basically right now, what was really interesting is every single FOMC member thinks that there's going to be no more rate hikes. So they're all sort of pegged at this level. And then as you go further and further, those dots sort of spread out. So there's some people who think that, at 2025, it's going to be 2.5%, and other ones. So anyway, that's just because I realize not everybody may not understand what the dot plots are. Sorry, Keith.
I wonder what that meeting looks like. Does everyone just get in a room, crush a couple Budweisers, and throw some darts at the board?
It's probably quite boring, I imagine. It's probably quite, they probably think they take those jobs very seriously, and rightly so. I think it's very, very important. And you're right, Steve. Your point is well taken. I think that they've you just got to be careful when you're like, I don't think investing on those dot plots is necessarily a good strategy. I think they can be fickle, as you've demonstrated. They move around a lot. I also think that they don't, they're also static projections. They don't incorporate what new information we'll have. So Keith made the point that if the interest rates are too easy relative to what the market needs, then you do get a re-acceleration in inflation, which you can make the case is it might already be happening, depending on what your indicator is. And then those dot plots will change in March and again in June, etc. So you have to be careful about taking too much stock into those ones.
It's so I participated in a couple mock Fed meetings before.
Cool. Is there buds?
There are no buds.
Guinness.
There are no
Steve.
buds.
It was Guinness.
It's I've gone to anyone familiar with the CFA Institute. They have an annual, I don't know what you call it, a seminar. It's for a week in Chicago at the University of Chicago, where
really
all that
boring.
stuff. Yeah. Hey, it's a lot of fun.
It's a lot of fun. How dare you?
Yeah. How dare you? And but you get to go anyway. It is really good because you get Fed speakers coming in. They actually go through some mock scenarios, and it's a lot of, like I say, it can be a bit of a boring conversation because there's a lot of data and people giving their thoughts and opinions, but it's very methodical. It's not just, hey, we should do this. Okay. You're the loudest one at the table. It is a lot of research put into it to come up with what we're going to do, whether it's right or wrong. With these dot plots, the last thing to think about, and Powell talked about it a few times yesterday during the presser. He said, it doesn't tell you what we're going to do. It just shares with you what each person is independently thinking on how policy might look a year from now.
Right.
That's all it is. So it's good because you want to know what they're thinking and how they view, but it's not a consensus view. I think, Steve, you just said, the chairman of the Fed, they always have the big stick. They're the ones who control it in the end. So Greenspan used to he would start off the meetings and go, okay, Rich, you're first, then Steve, and you go through everyone else. You explain your view on what should be done. And Greenspan would wait until the end. He would go last and basically saying, well, you're all right or wrong, but this is what I think we're going to do, and we're going to do it. Bernanke did the opposite. He always led each one. He was a tone setter. So he would start off by saying, this is what we're seeing. This is what we're not seeing, and, go that way. So every Fed chair, they have their own style in how they do it. I have no idea what Powell is doing. I've been involved in that kind of a mock with him for a long time. But again, the media, it's very serious. By the way, if anyone was to the presser yesterday, the questions were outstanding. I think if there were 10 questions in total, one was stupid and 8.5 were like really strong, legitimate questions. So it was a good meeting yesterday. Other times it's a bit fluffy, like the European one today is fluffy.
Yeah, I think, Keith, to your point, it's tying this back into my world, which is the Canadian real estate market. I look at the Canada 5-year bond and how much that's moved over the last 2 months. So it's down 120 basis points in 2 months, which is a pretty wild move for the bond market. And right now you've got yields about 20 basis points higher than where they were in the spring. And if you remember the spring of this year, we had a pretty robust housing market because what happened was you had mortgage rates, your 3-year mortgage rate, which was what everyone was taking out, came down to about 4.7. So 4.7 was kind of enough to kind of move the market. Today, banks are obviously slower to pass through, but you can get a 3-year today at about 5.6, 5.7. And I think that's going to slowly come down over time. But the thing I wanted to sort of emphasize is regarding to that soft landing. So let's just say hypothetically, and I think this is a very realistic possibility. In fact, I would say it's a high probability, is that you're going to get mortgage rates in this country in the new year will be back in the 4s. But for a lot of Canadian households, like we just had the debt servicing ratio in Canada just hit an all-time high. So having mortgage rates at 4.7 or even 4.5 isn't going to stave off a lot of difficulties for some of these Canadian households, which is like at the end of the day, yes, it's down it went from 6.3 back down to 4.5, but you have to remember that we went from basically 2% or whatever you want to call it, depending on when you signed on. You went basically, a lot of Canadians are still going to be renewing, from 2.5% to renewing at 4.5, and that's going to be a substantial jump. When in reality, Rich, your incomes on a inflation adjusted basis really haven't kept pace. So I still think this doesn't stave off that sort of wave of insolvencies. And the same thing on the developer side, right? Which is, okay, prime rate, which is what these developers borrow off of. Prime rate comes down, let's say 100 basis points next year. It's still going to be up 400 basis points from 2 years ago. And so I don't think that staves off a lot of insolvencies in that space.
Yeah, you beat me to it, actually, Steve. I couldn't have said it better myself, so I'll just be quiet. No, I'm kidding. No, honestly, that was exactly right. I think your point about the debt servicing cost, which I think the data came out on the 12th, it hit an all-time high. Again, it's different for different families. I get it. It's also different for what kind of credit you're thinking about, whether it's mortgage debt or credit or consumer credit debt or whatever. But in aggregate, we're at an all-time high. And you're right, we haven't seen, in my view, I think Canada and the US are totally different. And one of the reasons why is back to this 30-year mortgage rate, and why I think that, you think about like what will happen, what will transpire over the next, like, let's say 24 months. Well, all these rate hikes that have been priced into the US, and now they're getting priced out again, that hasn't affected US consumers at all. And this is why I think, as much as everyone is cheering themselves for these 6 or 7 rate cuts, if US consumers just keep ticking along and have 5% wage growth, the labor market is still tight because we know that there's demographic-led labor shortages, and you have a re-acceleration in, let's say, energy prices because, Saudi keeps cutting, or you have the base effects come through, and you have a re-acceleration in inflation rates. That's totally different than what's happening in Canada, where you still haven't had the feed through from these higher interest rates. I think a balance sheet recession, which we've discussed sort of at the Loonie Hour live, those things start to happen, and that when that phenomena begins, it's very, very difficult to stop it. Once people feel like their household is no longer a source of wealth and they retrench, it's very, very difficult, in my view. I don't know, Steve, maybe you'll correct me if I'm wrong, to sort of change that psychology, going from something was a net boost to your wealth to something is now a net drag. And so those debt servicing ratios, I think, are absolutely what Canadians should be thinking about, and why I'm not as convinced that risk assets should be, especially in Canada, should be as sort of euphoric as they have been. Keith.
So what's it's great now then, like over the last 48 hours, again, for everyone, this has been a significant move across all markets over the last 48 hours. And maybe that change has been enough. Because remember, like we're just looking at it from a housing market and mortgage renewal or developers. Okay, can they survive and stuff like that? Remember, if someone is sitting out there on 10 million, they're looking to invest in, I don't mean the market, but in a capital project of some kind, whatever it's going to be. If they think they now just say they can borrow, I say it's 50 basis points lower than it was a year ago, maybe that's enough for them to say, yeah, we're break even at worst now on this project. Do you know what I mean? They're going to say, yeah, we're actually going to go ahead and do it. And then there's another 10 guys behind them, they see the same thing and then they're doing it. I don't mean the money is going to the housing market. Like maybe it's going to a technology startup or, anything, right? You name it. Maybe a new oil and gas, new oil discovery, maybe because they want to produce more oil, Rich. Maybe not.
I won't take the bait.
Yeah, I know. I was trying to. But my point, though, is that, again, the hope here with monetary policy, all the central banks now this morning or this afternoon now, they're saying, hey, maybe this is enough of a little push to make investors feel a bit more comfortable or less anxious about doing something. And then maybe, I'm just taking the contrarian view here. Like maybe that is enough to produce this, sort of soft landing. So we'll have to see if we get carry through here. Because, again, it's been a pretty extreme move with rates right now. And this could all reverse itself or, retrace half of it, by Monday morning as we're going there.
So,
but this is not a bad move today. Like from a risk perspective, it does help reduce financial stress for a lot of families and some companies looking to borrow and everything. But it is the flow of credit. We have to see if it gets thrown through. I'm like you, Rich. I think this is just a euphoria that's been reached because of what's happened with the change in monetary policy. But you mentioned the 30-year earlier in the U.S. The 30-year was at 1.25% in 2020.
Mm-hmm.
Then it shot up to 5% or a bit over 5%. Now it's back down to 4%, which is like an amazing change, going from 5 to 4 in, a matter of, a few weeks. But, maybe that's enough to switch things around. But it is still a pretty dramatic movement over 4 years.
what are you looking for, Keith, in terms of next moves? Like, if you're just listening to this podcast, you're an investor trying to get a handle on markets. Is there anything in particular that you're looking for over the next little while here to see if this thing's got some legs? Do you know what I mean? Like, is this just
Yeah,
hope?
because let's be clear. Yeah, the only legs that have been established right now is what you said. It's hope, right? That's what it is. For us, I'm really interested in what happens with the Canadian GDP data that's going to be coming out. I think it's next week. We'll get the next monthly print. I don't quite remember. I think it is. But yeah, you want to see growth, whether it's the GDP print or, ISM diffusion index and employment as well. And those are the two key metrics to look at, for Canada. And if the GDP number is, remember, it was pretty negative for Q3. If that momentum carries into Q4, then, it doesn't matter if rates got, 30, 40 basis points cheaper or not. But it is the consumption side, Steve, for us, what we're looking at.
You have to think if you do get like that soft landing starting to filter through, which is like, hey, the data starts coming out, right? Canada GDP or US GDP, whatever, over the next couple months, you have to think that bond yields will start to have to back up again.
Yeah. Well, that's
Right.
the worry, right? Yeah, absolutely. So that's the worry with sort of the move we've had right now. And, maybe I've been too negative. And so that's something that's a bit of egg on my face. And the reason I've been sort of negative is because to me, I'm a more of a fundamental guy than Keith. I think Keith, he's more about flows and sentiment, and fair enough. It's worked very well for him. And for me, it's always sort of about earnings and what are companies generating more earnings, are margins strong and stable, and our sales growth. Do you have sales? Do you have earnings? And obviously the margin is sort of the quotient, right? And so for me, you have this big move has not been met with, basically has not been a function of stronger earnings. The earnings are basically flat to down over the last, let's say, year. And most of the fluctuation in your price is a function of your price earnings ratio. So how much are you willing to pay for one turn of earnings? And that has been directly related to the financial conditions. So the tighter your financial conditions, the less willing you are to pay for that next return, and the easier your financial conditions are, the more willing you are to pay for those financial turns. Which is why like long duration stocks have done so well. And so that's the worry you have, unless you have a flow through, as Keith alluded to, from some kind of growth impetus, whether it's in the US or maybe Europe starts to recover because they have less pressure from the energy, or something that comes through to lift those earnings to reward people for overpaying. To me, that's like that's a dangerous setup for next year. The other thing I would just quickly add is that you have a total change in mindset with respect to positioning. So this time last year, everyone was absolutely, me included, shame on me, but me included, that there was going to be a recession in the US, and positioning reflected that. So everybody was out of stocks. Now this time you have a total reversal of that, and positioning is not stretched necessarily, but if you look at things like the American Association of Independent Investors, that's nearly at the highs. But the problem is that your earnings revisions ratios, so the analyst expectations for next year, are starting to deteriorate. And so you have you have 3 or 4 different sort of cross currents of financial conditions, actual easier financial conditions, expectations of them, and then positioning, and then growth, which is sort of the missing piece for all this. Because if you don't have some kind of growth to support these valuations, I think you're in trouble next year.
The other thing to think about as well is, we're talking about like broad view, stuff here. I love anecdotal data. I love
me too.
Evidence and stuff. So like this week, I know it's E&Y, so Ernst & Young, the big, global accounting services kind of firm. They announced layoffs. Right. So they're doing layoffs with the partners in the US. So like, Steve, you're talking about like, what are you looking for next? The economic data is always lagging because you have to wait for it to come out. But you'd want to see, instead of companies announcing layoffs, you want to see them announcing we're hiring, we're opening a new, production plant here in there. And so those are the little, clues, you're looking for. I mean, the other thing here, like if they have the 10-year and 30-year, we'll use the 30 years as an example here, but like go from, 5 down to 4% in the US in such a short period of time, that's similar in magnitude with what happened with the 10 and 30-year, just as when the pandemic was starting. So from like January of 2020 down into like March or April. Now bring that up because the reason, the 10-year fell so much then, because it was the end of the economic world. The global economy was going to stop, right? That's what was happening. And, it wasn't considered an awesome time economically and financially. So now we've had the same move in the yield curve, or so long rates, the same thing. And the perception that this is considered to be positive because economic growth is something. Do you want to see it, or Rich? Like something?
Yeah, of course. I totally agree with you.
Yeah, it doesn't reconcile here, and but that's why it's a great puzzle. Economics and financial markets. It's never a linear line. Like there's always something moving along here. But again, this is such a large, abrupt move across all markets, especially the rate market. The bond markets are now telling us we're going to go into, a pretty deep recession, if you think about it.
And the stock market's making all-time highs.
Yeah, so maybe they're both a bit wrong. It'll be somewhere in between. But again, something has to, self-correct coming up. So start looking for anecdotal evidence. So when PGM starts tripling their workforce, and you see things like that. It is PGM, right? Or PMG? We keep getting it mixed
PGM
up.
Global.
PGM.
Shame on you guys.
BGM.
There's a couple of things that people can just like keep track of, sort of when they're doom scrolling on Twitter or whatever. I like to look at, just for in terms of growth. You could look at like oil prices are usually sort of an indicator of, again, you could argue it's lagging, okay, but it's just something that people can follow along at home. Think price of copper. Iron ore and steel prices are usually an indication of whether or not people are, investing in new products and new manufacturing, or building cars and ships and stuff like that. Dr. Copper, we've talked about that. Copper's used in absolutely everything going forward. In my view, there's going to be a structural deficit because of EVs and electrification, but also just because the world needs copper, and we haven't been we have not been exploring and sort of trying basically to build up the structural supply base that we need. And so it's very, very sensitive to actual industrial demand and growth. And so it's just easy stuff that you can like just Google the price of copper and see how that's going. And sort of it should, in most of the time, give you an indication of how the sentiment with respect to growth and what's going on sort of in background.
Yeah, speaking of oil, actually, just to circle back, Rich, on your rant last week, which I think in general seemed to have a lot of good feedback. So we always appreciate, the listeners and honest feedback, right?
I think one person called Rich a national treasure.
That person was probably my mother.
Sorry, Steve. It's such a great.
Oh, but yeah, of course. I mean, Canada is obviously doing they're capping basically oil and gas emissions, right? So that's going to be like a cap and trade, as we talked about last week in the show. But there's a report out today from economist Trevor Tome. I think he's in Alberta, but he's actually very balanced. For example, like, and whether I agree with everything he says or not is always up for debate. But I would say he's an incredibly balanced individual, and he just put out a piece saying that he was kind of against this cap and trade, basically saying a 10% hit to productivity in the oil and gas extraction sector shrinks Canada's economy by approximately 1.2%, which is equivalent to roughly $35 billion a year, or nearly $900 per Canadian. So again, a 10%
Canadian,
hit.
like even babies have to pay $900.
Yeah, 10% hit to productivity in the oil and gas sector will hit all Canadians. So, keep that in mind when we're trying to contain cow farts and capping production in our energy sector, Rich.
Well, I mean, one thing that I forgot to sort of mention is sort of the optimistic view. I think I was maybe too negative in some ways. Someone tried to correct me on the Drax thing, and I tweeted to them, and I got that right. I think I made a mistake about it was London Heathrow that claims that it's 100% renewable, not London. So that was my mistake. But the real issue, the other issue I think I would just suggest is like we have a real opportunity. I think that's the thing that, it gets lost in all of this. Instead of sort of trying to kill the golden goose, we have an opportunity to really improve the golden goose and give it a nice little home and give it maybe some friends, and maybe we can play hockey for it to entertain it on the weekends. We can make this golden goose comfortable and really provide an incredible amounts of value. And I don't mean just value as in cash. I mean value as in support our wobbling healthcare industry, and we could do all kinds of really weird and wonderful things with that kind of those resources. And so I think that that's often forgotten. I think that that's something maybe we should, instead of being so negative all the time, maybe offer sort of positive reinforcement, maybe. But
well, do you mean the golden cow and not the golden goose?
No, that's a sacred cow, which we're not supposed to worship, right? Especially around Christmas. But then there's the golden goose, I think, is right.
Cows are bad.
What is it? Golden idols in Sodom and Gomorrah? I think that's the first Bible reference on the Loonie Hour ever.
I'm having a steak for Christmas Eve. I don't know about you.
Yeah, wow, that's nice. I think we do chicken in my house.
I'm gonna get canceled. Keith?
No, we're going to survive, guys. We're going to be fine.
Pizza guy?
For Christmas Eve? Is that what you mean?
Would you do Christmas Eve or you just do Christmas?
We do both. Christmas Eve is always sometimes
4
takeaway, or a bunch of tasting plates, hors d'oeuvres, and things like that. And then Christmas Day, it's the full on. Yeah, we're fancy out here.
Our family does nothing on we never do anything on Christmas Day. Ours is always Christmas Eve. I guess because I'm Catholic. I guess I'm technically Catholic, and we're Portuguese. So the Portuguese and the Spanish, I think they always do it on Christmas Eve.
I'm a big Christmas Eve guy.
Yeah,
I do. I mean, I do both, but
So when do you open your present?
Me? We used to, as a kid, I do 12 midnight. Midnight.
Really? That's weird, man.
What about you, Steve? Like, is it some people do like morning. Christmas Eve? Yeah, same with us as well. Yeah, we have a lot of fun with it. So, but did you want to? Were you going to mention the Philippines or no? You had
Uh,
that or no?
well, I don't
That's
know. I mean,
not a
it
big
kind of
deal.
ties. I think we had enough of a rant from Rich last week. I don't want to get
Yeah,
into this,
yeah.
Mr. Gilbo being the worst man in Canada, but
Let's save
yeah.
it. Let's save it when for the next time.
I mean, anyone can Google it. Let's just put it this way: is Canada sending $5 billion or financing $5 billion of some green ticketed slush fund to the Philippines? I don't know why they're sending it to the Philippines. Even our editor Jeff, who got us together, is a bit confused. But
Oh, your
Pause.
sound cut out.
We lost your sound.
anyways, there, Jeff, you're welcome for the $5 billion. Fill your boots, buddy.
This time, like I love seeing, interesting stories, funny stories, stories you look twice at, say, wow, what's happening? One was definitely the one how the world is going to have to try to control cow burps going forward because that's going to change
Isn't it
the climate.
farts?
No, now it's
both.
burps.
You
Yeah,
got to plug both ends.
it's coming
What?
out of
It's-
both ends.
I thought it was.
Yeah.
Oh, in Ireland, it was definitely the farts. But anyway, sorry, I interrupted you.
But now it's the burps in Canada. So
Okay.
maybe if we have any farmers on as listeners, they can tell us how they're going to do that.
Well, you'll be
are
happy to
gonna-
know. You'll be happy to know that meat consumption, full stop, globally is rising and continues to rise. So,
Eat the bugs.
Eat sea bugs. And then the other one, so Argentina, they have a new president or prime minister. What do they have?
well, the
Emperor.
nut job. He's a bit of a nut job.
He's been around for weeks now, man. This is
The
not
guy with the
news.
chainsaw. I know, but he had his big like welcoming speech to the nation. He did that this week. And then it's kind of you have to read it, right? It's just amazing.
He's
like,
amazing.
oh well, yeah, cool stuff. I don't think you'll have any success, truthfully, because you have to change the culture, and that's really hard to change. But the very next day, that same day or the next day, he announced he's going to cut the number of government employees by half.
Wow.
You talk about being a productive economy. That's the first thing you do. Things like that. So now here in Canada, like the number of government workers we have relative to the economy, it's been creeping higher and higher.
Creeping.
And,
It's been soaring higher.
Rich, you have that
Soaring.
chart. You put it out like a year ago.
I put it out long ago.
Yeah.
All this data,
Also-
by the way, is public. I'm smart, but I'm no genius. You can go look it up yourself. Anyway,
So
sorry.
the guy like ties in with this. The American guy who's running for the leader of the Republican Party, Vivek Ramaswamy, I think his name
Yeah.
is.
well pronounced.
Hey, thank you. And he actually said, yeah, he would cut the number of federal employees in half. And of course, everyone is so political down there. Said, "Oh, you're just going to fire everyone who leans Democratic." And he said, "No, it's much simpler than that. We just simply look at the last number of your social security number, and if it's even, you stay working. If it's odd, you're gone."
That's amazing. I mean, that's totally nuts. That's nuts, but amazing.
Oh, it's very dramatic, but there's a way to do these things, and like the response is just jaw dropping, right? Oh, you can't do that. But anyway,
Whether you
I
like
guess-
him or dislike him, that guy is good for a few sound bites.
He's great for sound bites. American
he's
politics
different.
next year is going to be a really. I mean, we try not to talk too much about politics on this show. We could if we want to. Believe it or not, folks, we actually bite our tongues pretty good. But next year is going to be really interesting. There's the UK, the US, Canada's going to get hot and heavy.
We got-
There's loads of
well,
stuff
we
going
got-
on in Europe.
While we're on it, last to wrap it up, we do have to quickly mention that, Keith. There's going to be a lot of people, and I would tend to agree with that, is that, people are going to say, hey, is Powell setting up the dovish pivot here because it's an election year coming up in the US and he's getting the little tap on the shoulder? I mean, I don't think we can bypass that and say that's a zero probability of why he's.
Well, they say don't let truth get in the way of a good story sometimes. That was one of the questions yesterday. And, his response is perfect. He said, hey, listen, we are not political. We are objective and neutral and all that stuff. But if they are going to do any cuts, you would imagine they have to be done by the summer because they're not going to be cutting in the fall going into the election, because then it was, it would be deemed to be, a very political move to do that. So, and also sort of the timing for Fed cuts is sort of, I think, is it Rich, March is supposed to maybe start, and then
Yeah, well, there's 8 meetings, so I think I can't remember. Yeah, I mean, there's a lot of stuff. There's a lot priced in. I think it's not going to happen, but anyway, we'll see. But March, yes.
Yeah, it's starting in March and then definitely in May. So really, they have about 3 meetings or maybe 4 to do stuff with, because then you get into that political period. So that's a good question, Steve. It's a good observation.
There you have it. Well, we'll see you next week. As always, we appreciate everyone's support. And like I said, we'll be here all holiday season. A little festive cheer for the Loonie Hour. Probably won't be much to talk about, but we'll just talk about Keith's dinner and all his Bud Lights that he's sucking back. All right. See you next week.